please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
On to a CNBC TV18 exclusive now. India should continue with the reforms initiated by the Modi government, and it should increase the pace of reforms, if not want to accelerate the pace of growth to 7.5%. That's the word coming in from renowned economist Nouriel Roubini. In a conversation with Lata Venkatesh, Roubini also warned against fiscal slippage and pointed at the rise in India's long-term interest rates on the back of these fiscal slippage concerns.
Budgets are very big events in India because they are policy announcements by the government. Now, one of the normal debates is, should the government increase the fiscal deficit and invest so that it can give growth a leg up? Would that be your advice?
My advice will be that, first of all, the budget deficit of India is still large at the central level, but also you have fiscal problem at the state and local level. And therefore fiscal prudence is necessary. And the risk is that even if you wanted to do a fiscal stimulus as a way of boosting economic activity, what you have observed in the last few months has been the long-term interest rates in India have gone higher, and have gone higher not just because of global factors, but more importantly because there was a concern that the fiscal deficits are too high. And even with the RBI marginally cutting policy rates, the impact on long-term interest rate has been just to slow down the rise of these long-term interest rates. And therefore, any positive impact on economic growth coming from a meaningful fiscal stimulus is going to be undone by a potential rise in long-term interest rates that's going to crowd out that recovery. Of course, the country is facing fiscal challenges also because when oil prices were falling, that reduction in oil prices were not transferred to the retail level, and it led to greater revenues for the government that were spent rather than saved in the good times. And now that oil prices are going higher, either you increase oil prices to maintain the same revenues, but if you do that politically a year before election, that's not something that's going to be appealing, and therefore the revenue is going to shrink and the budget deficit is going to be rising. That requires fiscal prudence, because otherwise you're going to have increasing long rates. Probably the way to square the cycle that you don't want to cut spending and revenues are falling and you don't have a larger budget deficit will be more divestments of state-owned enterprises and selling to market and partially privatizing some of those assets. That will be good for the economy, and it might be loosening up the budget constraint that the government is facing.
So one advice to Prime Minister Modi?
The advice will be that he has started the process of a variety of economic reforms. More need to be done, and the more those reforms occur, the more chances are that potential growth of India goes from 7% to 7.5%, from 7.5% towards 8%. But to get to 7.5%, 8%, current policies probably are not sufficient, but more needs to be done. And if he wants to pass to history with the legacy of having changed for the better India, definitely he should be continuing with the same policies in the near future.